Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your host here at AlgoBot, and today we're exploring an expert advisor called Volatility Expansion Pullback. This is a trend-following continuation strategy that blends two average true range readings into a single volatility expansion gauge, and then pairs that gauge with a fast and a slow-moving average to time-patient pullback entries. By the end of this video, you'll understand exactly how it reads the market when it arms a trade and how it manages its stop-loss and take-profit. Remember, this is educational content only. Let's dive in. So what does this expert advisor actually do? At its heart, Volatility Expansion Pullback is built around a simple observation many traders talk about, that sustained directional moves are often born out of a sudden expansion of volatility rising off a quiet base. The moment short-term range swells relative to its own longer-term baseline, it can suggest that one side of the market has taken control. To measure that, the strategy calculates two average true range values. One is a short window, the fast reading, and one is a longer window, the slow reading. It then divides the fast reading by the slow reading to produce an expansion ratio. When that ratio climbs above a set threshold, the strategy treats it as a fresh swell of volatility worth paying attention to. But here is the key design choice. Many systems chase that very first expansion candle, which often means entering at the widest, most stretched price with the largest stop. This strategy deliberately does the opposite. It uses the expansion only as a signal to start watching. It notes the direction of the move using a slow trend moving average, and then it patiently waits for the very first shallow pullback into a fast-moving average, entering only when price reclaims that line. The result is an approach that aims for a calmer entry price, a tighter stop, and added confirmation that the pause was just a pullback rather than a full reversal. In terms of markets, the strategy is designed with a liquid foreign exchange major in mind, such as the euro against the US dollar, on intraday timeframes like the 15-minute or 1-hour charts. It's suited, in an educational sense, to traders who are curious about trend and momentum continuation and who prefer waiting for a defined pullback rather than jumping in on the first burst of activity. As always, trading involves risk, and losses are a normal part of any strategy. Nothing here is a promise of results. Let's walk through the exact logic, step by step. Everything is evaluated on the last fully closed bar, and the strategy takes at most one action per closed bar, so it never reacts to a candle that is still forming. First, the strategy builds its expansion ratio by dividing the fast average true range by the slow average true range. On each closed bar, it compares the current ratio to the previous ratio. When the ratio was at or below the burst threshold and then crosses up above it, the strategy detects what it calls an ignition, a fresh swell of volatility. At that ignition moment, the strategy checks direction. If the closing price is above the slow-moving average and the fast-moving average is also above the slow-moving average, it arms a long setup. If the close is below the slow-moving average and the fast line is below the slow line, it arms a short setup. If the picture is mixed and direction is ambiguous, it arms nothing and simply keeps watching. Once a setup is armed, a countdown begins. The setup stays valid for a limited number of bars, defined by the setup bar's input. During this window, the strategy watches for two things in sequence. First, a pullback. For a long, that means a bar dips down so its low touches into the fast-moving average. For a short, a bar rallies up so its high reaches the fast-moving average. Second, the reclaim. For a long, the entry signal is a bar that closes back above the fast-moving average after the pullback. For a short, it's a bar that closes back below the fast line. Because a single rejection candle can both dip into the line and close back on the trend side, that one bar can complete the setup on its own. There are two ways a setup is canceled before it triggers. If the countdown runs out without a valid pullback and reclaim, the setup is dropped. And if price closes across the slow-moving average against the setup's direction, the trend picture is considered broken and the setup is invalidated immediately. When an entry does fire, risk is scaled to volatility using the slow average true range. The stop loss is placed at the stop multiplier times the SlATR away from entry, and the take profit is placed at the take profit multiplier times that same reading. The strategy holds only one position at a time, identified by its magic number, and from there the stop loss and take profit manage the exit. Let's look at the actual MetaQuotes language code that runs inside MetaTrader. At the top are the inputs you can adjust. FastEma and SlowEma set the pullback line and the trend filter. ATR fast and ATR slow are the two average true range windows that form the expansion ratio, and ATR slow doubles as the risk unit. The burst threshold, defaulting to 1.30, is the level the ratio must cross up through to ignite a setup. Setup bars controls how long a setup stays valid, while the stop and take profit multipliers, 1.8 and 2.7, scale the exit distances. Now to the two signal blocks. When the strategy has armed along, marked by the direction being positive, the first line checks whether the bar's low dipped into the fast-moving average, and if so, it flags that a pullback occurred. The next line is the entry condition. Once that pullback flag is set, and the close comes back above the fast-moving average, the strategy calls trade.buy. You can see the stop loss placed below entry by the stop multiplier times the SlowATR, and the take profit above entry by the take profit multiplier times that same reading. The short block is the mirror image. When direction is negative, the code checks whether the bar's high rallied into the fast-moving average to flag the pullback, and then when a bar closes back below the fast line, it calls trade.sell. Here the stop sits above entry and the take profit sits below, using those very same multipliers. Both sides share one clean, symmetrical structure. Let's bring the whole idea to life on a chart. On screen, you can see price candles with two moving averages drawn over them, the fast line in gold and the slow line in blue. Beneath the price is our volatility expansion gauge, the ratio of the short average true range to the long average true range, with a dashed level marked at 1.30. We open in a quiet market. The first candle is small and calm, and the expansion gauge in the lower panel sits well below the 1.30 line. There's no swell of volatility here, so the strategy simply watches and does nothing. Then look at the second candle. It's a wide, decisive candle to the upside, and notice the gauge below leaps upward and crosses above the 1.30 level into the green expansion band. That upward cross is the ignition event. Because this candle closes above the slow-moving average, and the fast line is above the slow line, the direction is clearly upward, so the strategy arms a long setup and begins its countdown, which lasts up to 8 bars. The third candle keeps pushing higher, confirming the momentum. Now the fourth candle is the pullback. Price dips back down, and the candle's low touches into the fast-moving average. This is exactly what the strategy is waiting for, a shallow pause rather than a reversal. It flags that a pullback has happened, but it does not enter yet. On that same pushback up, price turns and closes above the fast-moving average, completing the reclaim. That reclaim is the entry signal, and you can see the buy entry marker appear right there. From the entry, the stop loss is placed below at a distance of 1.8 times the long average true range, and the take profit is set above at 2.7 times that same reading. That works out to a reward-to-risk ratio of about 1.5 to 1. Over the next couple of candles, price extends higher in the direction of the trend and reaches the take profit target, and the long trade is complete. Now watch the market roll over. Price tops out and begins sliding down. Over the next couple of candles, the fast-moving average crosses below the slow-moving average, flipping the trend picture to the downside. Then, on the ignition candle to the downside, the expansion gauge once again springs up through the 1.30 level. This time price is below the slow-moving average and the fast line is below the slow line, so the strategy arms a short setup. Price continues lower, and then we get our pullback in the opposite direction. A candle rallies back up, and its high pushes into the fast-moving average from below. Again, the strategy notes the pullback but stays patient and waits. On the following candle, price rejects that level and closes back below the fast-moving average. That is the reclaim to the downside, and the sell entry marker prints there. For the short, the stop loss sits above the entry at 1.8 times the long average true range, and the take profit sits below at 2.7 times that reading, the same reward-to-risk shape as the long. Price then works its way down, candle by candle, until it reaches the take profit target below, completing the short trade. Notice how, in both cases, the strategy never chased that first explosive candle. It waited for the pullback and the reclaim, aiming for a calmer entry and a tighter stop inside an already expanding, trend-aligned move. And if a pullback never appeared within the countdown, or price had closed across the slow line the wrong way, the setup would simply have been canceled with no trade taken. And that's volatility expansion pullback from start to finish. We looked at how it turns two average true range windows into a volatility expansion ratio, how an upward cross through the burst threshold ignites a trend-aligned setup, and how the strategy then waits patiently for a pullback into the fast-moving average and a reclaim close before entering. We also saw how its stop-loss and take-profit are scaled to the slow average true range for a consistent, volatility-aware exit. As always, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please consider liking the video, subscribing for more MetaTrader 5 strategy analyses, and leaving a comment with the strategy you'd like us to cover next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.